Welcome, FinTech Talkers. Embedded finance is still one of the most important distribution models in financial services. But it's not as simple as it used to look. The easy story was add payments, add credit, add a wallet, and you're in the game. The harder reality now is that many embedded finance programs are running into compliance friction, weaker economics, inner integration, and new AI governance questions. Yeah, it's 2026, a lot of AI. So, what separates embedded finance that actually works from embedded finance that is just a feature? Today, I'm joined by Raman Aulakh, who's here in an independent capacity. He has an illustrious career in financial services and fintechs, big names that you can check out. But he's here today in an independent capacity to walk us through a practical 5 condition framework for evaluating embedded finance strategy. And we'll look at it from 3 angles. The endpoint, like a retailer or a vertical SaaS platform where the finance service is typically embedded. The embedded finance enabler or platform, like a BNPL or an orchestration provider. And the issuer or the balance sheet partner who behind the scenes funds it in terms of credit or even in terms of payment, it's the money mover and so on. So let's get into it. You are watching FinTech Talk, sculpting the future with AI, crypto, and FinTech. Welcome back to FinTech Talk. I'm Patty. If you like deep dives on the future of FinTech infrastructure, AI, and the changing mechanics of commerce, subscribe and share this episode. Raman, welcome to the show.
Thank you, Patty. Great to be here.
Awesome. So, quick note for listeners. As I said earlier in the introduction, Raman is joining in his personal capacity as an independent thought leader. The view he shares today are his own and not necessarily those of his employer. So let's dig into kind of embedded finance, and we put in some introduction. It's still big, but the market has really changed. So let's level set. It's still clearly a major force in distribution of financial services. The market, although after a lot of kind of regulatory issues and things that have happened a couple of years around, especially in BaaS, the market feels more disciplined now. There's more scrutiny on sponsor bank models, more pressure on economics, and a lot of people are realizing that distribution alone is not enough. So, Raman, how do you see the state of embedded finance today?
Yeah, I think embedded finance is absolutely still a major force, especially as a distribution model. The difference is that we've moved past the phase where simply adding a financial product to a platform was enough to create value. That's changed because right now the operators have learned some hard lessons. Not every platform truly owns the workflow. Not every platform has the kind of real-time data needed to underwrite or treasury decision work. Not every embedded finance program creates strong economic value so that they can justify the operational and the compliance burden. What it brings us to is embedded finance is still highly relevant, but the bar is much higher now.
Interesting. So, if I can paraphrase, so the story is not that embedded finance is fading, it's just that the market is getting more selective.
Absolutely. And that's exactly the case. For some successful programs, the ones that have tightly aligned core workflows, where platforms have meaningful data, the economics are real, and where regulatory models are thoughtfully designed, those are the ones that are successful. The weaker programs are now getting exposed.
Very interesting. So, you've shared your framework with me offline, and so this is a great setup for your framework because it sounds like the problem now is less should we do embedded finance and more under what conditions will it actually work?
That is exactly the question.
Okay, so let's get into that framework because that's what we want to talk about. So this is not just something you came up like off the bat. You worked in this space for what, like a decade now, or how like embedded finance or its precursors? How many years have you worked in it?
Yeah, I've actually been in fintech and payments for a long time. I've seen all versions of fintech products and financial products being embedded into platforms. And in the past recent years, I've been very, very deep into the embedded finance space because I now, lead products in that space. So I've seen it from all angles at this point, and which is why I was able to kind of put some thoughts together on what I think are the determining factors for a success of the embedded finance model.
Okay, so if you're listening, either on a consuming side, distributing the embedded finance service, or the platform side, or as a bank who's offering of their balance sheet or other services towards enabling embedded finance, this is a framework you need to pay attention. So let's get to the framework. You've said that there are 5 conditions that determine whether embedded finance is durable. Let's walk through one by one, and I want to explicitly tie them to the challenges the market is dealing right now. The first one is workflow ownership. You briefly alluded to this. Why is this the starting point?
Because one of the biggest challenges in embedded finance today is there's a lot of companies that don't actually control the movement or the moment where the financial entity, the financial intent is created. They may have traffic or attention, but they don't own operational trigger. The true workflow ownership means the platform controls transaction moment or a cash flow inflection point. For example, you could think about checkout moment, invoicing creation, claims payments or vendor payments, reimbursement. All of those are transaction moments that can be inflection points. And if you own that moment, the finance can become native. If you don't own those moments, then the embedded finance is usually just a thin layer for those platforms.
Interesting. So this already addresses one of the big market problems, weak distribution quality. A lot of embedded finance programs may have access to users, but not real control of the workflow.
That's exactly right. And that matters because weak workflow ownership usually leads to weaker conversion. It's weaker retention, weaker economics, and even less durable positioning because you don't control the meaningful moments for the consumers of the embedded finance model in itself.
So going back to your framework, so your framework helps companies avoid one of these biggest strategic mistakes, confusing audience access with what you just described, workflow ownership.
Yes. If you want embedded finance to work, start by asking where exactly is the native trigger point? And do we actually control it?
Perfect. So let's move on to the next condition, which is data density. Why is this even more important now and today?
Yeah, so because one of the core challenges in embedded finance is that people underestimate how much decision useful data is required to move beyond a single payment. Payments can work with relatively limited context, but when it comes to lending, treasury, insurance, or dynamic pricing, and even like AI driven decisioning, they need better signal. You need real time operational data. For example, sales patterns, refund rates, your invoicing velocity, your claims history, overall fulfillment behavior, and liquidity cycles. So, all those aspects are important and they are. The data density is very, very important for those aspects to be relevant and useful. Without that, you may be distributing a financial product, but you're not really improving financial decisions.
Okay. So this also seems to be where some of the weaker embedded finance models break down. They have access to the channel, but not enough proprietary data to create better underwriting in the case of lending or smarter risk management.
Exactly. And that becomes even more important with AI. AI doesn't solve weak data foundations, as we all know, it amplifies strong ones. The workflow is rich. If the workflow is rich and the data is dense, AI can definitely improve underwriting, pricing, fraud controls, and other aspects. If the underlying data is weak, AI just adds noise and governance risk.
Yeah, terms like hallucinations and stuff like that. But I see what you're saying. So the data richness is key. So your framework also acts as a safeguard against black box thinking. Don't just ask whether AI can automate a decision. Ask whether the underlying data actually supports better decisioning.
Yes, and more focus is going towards the cleanness of the data that's underlying and powering these workflows. So AI can be a force multiplier, but only after the structural conditions are in place.
Okay, so let's move on to the third leg, which is the economic upside. And that's very relevant now with a lot of margin squeezings everywhere. This means a lot of people are asking whether embedded finance is still attractive once compliance, servicing, and operational costs are fully accounted for.
Yeah, this one's the biggest question in the market today. Payments alone are increasingly commoditized. Many programs that looked exciting at launch don't look as compelling once you factor in the fraud, the servicing, reversals, compliance overheads, and partner economics. So embedded finance has to create meaningful economic value. That can be in terms of direct revenue, but often it's broader than just that. It's more about high conversions, stronger retention, overall lower cost of acquisition, even deeper switching costs. So all those aspects kind of roll up to eventually bringing economic value, but the companies that are working in the space have to pay attention to those aspects rather than just looking at volumes itself themselves.
Right, right. So this is a big part of how your framework alleviates the economic challenge. It forces operators to ask whether finance is truly improving the business model or just adding a product layer.
Yeah, absolutely. And it also helps each player see the economics from their own lens. The endpoint may care about retention or wallet share, but the embedded finance platform may care more about distribution efficiency and take rates. The issuer or the capital provider may care more about better originated assets or lower losses. If the economic side isn't clear for the ecosystem, then the program is bound to struggle.
Yeah, and we talked about the ecosystem broadly, three players. Obviously, there are more players, like including consumer and stuff like that. But the end point, which is usually a vertical SaaS or retail POS and so on, the platform provider, which is kind of the embedded finance platform, and then the balance sheet, the issuer or a bank at in the bank. So this is valid for all. So when you are starting an embedded finance program, this economic issue is something that you need to strongly consider. And Raman's framework means a five pronged framework, but the economic point is really a strong point. Embedded finance fails when it is strategically vague and economically thin. So let's move on, maybe, Raman, to your fourth point. And we've seen a lot of stuff, especially in the BaaS, around regulatory issues with some of the providers in the embedded finance space. So it is important. So it's the regulatory leverage. This is one of the areas where the market has clearly become more demanding. Sponsor banks, BaaS partners, and regulated entities have become much more cautious.
Yeah, absolutely. And one of the biggest challenges today is that compliance and operational complexity were underpriced in the early generations of embedded finance. People focused on the front end, the user experience, and underappreciated the burden that behind the scenes of KYC, KYB, AML disputes, and audits, ledger management, all of these aspects brought in. The question is not, can we launch this product anymore? It's about, the right question is, how do we structure the regulatory model so that each party owns the right responsibility to ensure smooth long term viability for the business to run?
Cool. So your framework actually helps by forcing clarity around the division of labor between endpoint, fintech enabler, sponsor bank issuer, and the program manager.
Yes, and that clarity is a strategic asset. The companies that win in embedded finance going forward will be the ones that design and the regulatory operating model intelligently and make it scalable.
And AI, talking about AI, that raises stakes here too. If AI influences approvals, pricing, fraud decisions, treasury actions, or account controls, explainability and governance become even more critical.
Absolutely. And AI does not reduce the need for governance. It actually raises the bar across several aspects. For example, policy guardrails, auditability, explainability, like you said, and very importantly, accountability.
Hmm. Moving on to your fifth, which is user pain intensity. Why is this so important right now?
Because one of the reasons some embedded finance programs disappoint is that they solve a weak problem. If the user pain point is low, adoption is bound to be low. If the user pain point is structural and recurring, then embedded finance becomes much more durable. That pain could be from cash flow volatility. It could be from delayed reimbursements, supplier payment friction, some of the things like inability to access working capital, where a lot of companies are trying to solve for the customer pain point. But it's very important for the platforms and the embedded finance providers to understand honing in on the customer problem, honing in on how deep the pain point lies, is very important for the long term success of the program.
Interesting. So this helps filter out the programs that are more kind of opportunistic than really necessary.
Yeah, it definitely helps filter out the superficial products that don't really retain or create long term retention for the consumers. And if you're not solving a high frequency, high intensity financial problem, then the finance tends to become a feature rather than infrastructure. Hence, there's going to be low retention because the feature will be only applicable in a small case scenarios.
So, just summarizing here, so what I love here is that your five condition framework directly addresses the real challenges in embedded finance today. Weak integrations are challenged by workflow ownership. Thin data is challenged by data density. Poor monetization is challenged by economic upside. Regulatory strain is addressed by the regulatory leverage. And weak adoption is challenged by the user pain and intensity. That makes your framework not just diagnostic, but strategic.
That's exactly how I think about it.
Okay, so we kind of talked about it in the abstract. Let's make it real. Let's make it practical. Same framework, three different lenses: the endpoints, the embedded finance platform, and balance sheet providers. So if I'm a retailer, healthcare platform, travel company, or a vertical SaaS platform, how do I use this framework?
Yeah, for the endpoint, the framework helps answer the sequencing question. Where should we start? What should we launch first? The first question is whether you actually own the workflow trigger. The second is whether the data in the pain point intensity is to support the product beyond payments. The third is whether the economic upside is strategic enough to justify the complexity involved in bringing in embedded finance. So rather than saying we need lending or we need cards or we need wallets, the better approach is to ask what financial product is most native to our workflow and most valuable to our users.
So for endpoints, the framework becomes a roadmap discipline. It helps them avoid launching too broadly or too early.
Exactly.
Okay, let's switch to the middle layer. What if I'm a BNPL issuer, a lending enabler, a payments platform, or a treasury orchestration provider?
Then the framework becomes partner selection, the program design filter. One of the major mistakes in embedded finance has been assuming all distribution is good distribution. It isn't. The best partners are not just the ones with user research, they're the ones that own real workflows, have dense operational data, serve users with clear pain points, and can support workable regulatory models.
Interesting. So this is how your framework addresses the challenge of the shallow distribution we talked about and kind of weak partner quality.
Yes, and it helps providers avoid programs that look big at the top of the funnel, but then are thin in conversion, in terms of risk, and also have fragile economics.
Mm. And last but not least, we are talking embedded finance, so there is a finance or a balance sheet provider at the end. So what about the issuer, the sponsor bank, or the capital provider? How does this apply to the framework applies to them?
Yeah, I think for them, the framework is really about market selection and risk allocation. The key question is not just about the demand, whether the demand exists or where the demand exists, but where the contextual data and the workflow control creates better assets and better servicing for them. The right embedded finance ecosystem can produce better originated receivables, more continuous monitoring. It could be lower acquisition costs. And last but not the least, improved risk adjusted returns, but only when the structural conditions are real.
So your framework helps capital providers like issuers or banks avoid simply chasing volume and instead focus on ecosystems with stronger underlying signal quality.
Agreed 100%.
Okay. So let's switch gears a little bit and talk about AI. Let's bring AI into the picture. You've said AI will not replace the framework, but it'll make the framework more important. Explain that.
Yes, AI changes embedded finance by shifting the model from embedded products to actual embedded decisioning. Instead of just static offers, you get contextual underwriting. Instead of fixed terms, you could get dynamic pricing. Similarly, instead of manual treasury management, you get more autonomous liquidity decisions. So, but in all of these, AI only creates durable advantage when it sits on top of the real workflow ownership, real data, density, and strong economics and clear governance, as well as the real user problem.
Yeah, interesting. So in a separate context, we've been kind of talking about AI in the loop versus human in the loop and so on and so forth. So in this context, the framework becomes even more important in an AI-driven market because it tells you whether the foundation is strong enough to support intelligent decisioning.
Exactly. I think AI can help alleviate some of the current challenges in embedded finance, but only when the structure is right. It can improve risk selection. It can improve, the ability to make pricing more precise, even strengthen fraud controls and optimize treasury. But if the problem already has weak data unclear responsibility or weak user demand, I don't think AI would rescue.
I love it. That's beautiful. That's a powerful line. AI does not rescue structurally weak embedded finance, it amplifies structurally strong embedded finance.
Yes, that is the distinction.
Awesome. Raman, this was excellent. The embedded finance market is clearly still a major distribution force, but it has grown up, it has matured. There were some kind of setbacks or things that didn't go, and that probably helped with the maturity. It is more regulated as a result, more economics driven, which is always good, more selective, and increasingly shaped by AI. What I like about your five condition framework is that it gives operators a real filter for what will work: workflow ownership, the data density, economic upside, the regulatory leverage, and user pain intensity. And importantly, it also helps how to navigate the biggest challenges in the market today, which is the compliance pressure, the thin integrations, weak economics, shallow data, and new AI governance demands. Where can people follow your thinking?
Yeah, I have a LinkedIn profile that I would be happy to connect with people on. So you can find me on LinkedIn. That's the place where I would be happy to connect with like-minded folks and also discuss any future-facing thought leadership ideas.
Awesome. So that's Raman Aulakh. So that's Raman Aulakh. Look him up on LinkedIn. It's very active. And to everyone listening, if you enjoyed this episode, subscribe to FinTech Talk. It's on all your favorite platforms: Substack, Apple, Spotify, YouTube, and you name it. Share it with a founder, product lead, bank partner, issuer, or investor trying to build the next generation of embedded finance. See you next time. Thank you, Raman.
Thank you, Patty.